Commodity correlations, a lot of movement in the commodity space. Here we have some metals highlighted. I also want to look at some energies here in a second. And I wanted to create a little bit of a correlation matrix, so to speak, at least crunch some numbers for you all on what commodities are correlated to what stocks and foreign exchange and interest rate markets here, because commodities can be quite volatile and trading them on their own can be a very volatile endeavor with a bunch of potential risk. I mean, you've got here gold, a market that has fallen from $2,000 down below $1,700 and now rallied all the way back to $2,000. A couple of 15 to 20% moves in the span of just a year here, and then silver even more volatile. But if we can draw some correlations, create some relationships with these correlations, you can maybe look at some potential pairs trades and some risk reduction strategies here. And you'll remember that correlation is a measure between two markets and how likely their prices are to move in the same direction. For example, here we have two commodities, gold and silver, with a correlation of positive 0.84. Now that's pretty darn high. The highest it gets is positive 1. And if you have a positive 1 correlation, that means that 100% of the time, these two markets are moving up together and down together in the same direction. And you only get that high of a correlation when you're comparing, for instance, the S&P 500 index to the ETF to the futures. Those markets almost always moving in the same direction, given that they're the same market, just some different products. And then in negative territory, if you have a negative correlation, that means for every day that the market A is up, market B would be trading lower. And of course, the in-between gray area is where most relationships lie, gold and silver being decently high. And you can see here, gold in black, silver in red. These markets are moving together for the majority of the last year plus of trading. Where the potential strategy comes in is if silver, for instance, falls harder than gold in the later part of 2022, and you think that silver will catch back up with gold at some point, it's undervalued relative to gold. You can buy some silver and sell some gold, and that way the market for metals can move lower or higher. All you're worried about is the gap between the two. And you can see a lot of people do trade that gold and silver. They trade back and forth with each other constantly, as you can see in the chart. But I wanted to take this outside of commodities compared to commodities and look at some correlations between gold and other markets in stocks and foreign exchange and interest rates here. And then also do the same with crude oil to give you a semblance of not only the relationship. So if you see, oh, that market's doing this, and so it's likely that this other market is doing that, but also look at the potential for pairs trading. And here we have a bunch of correlations that are maybe not as high as, a gold and a silver at positive 0.84, but you do see like gold and Japanese yen at positive 0.72. That's really intriguing there. And it makes sense, right? Traditionally, both those markets are viewed as flight to qualities. And so in times of fear or unknown, people will buy gold and buy Japanese yen. And you can see on the inverse, the negative side, negative correlations to bank stocks, negative correlations to interest rates and US dollar, markets that for the last few months here have been synonymous with the antithesis of fear, right? They've been more risk on. And so what you're seeing with that negative correlation between gold and bank stocks, for example, is when bank stocks are showing fear, when they're moving lower, gold is tending to be moving higher. Makes sense, right? People are fearful of the regional banking crisis, selling their bank stocks, and at the same time, maybe buying gold as a hedge against that fear, a flight to quality. Similar with interest rates moving lower as people get more fearful, and gold prices moving higher. Crude oil, it's a different type of animal, obviously. Looking at gold, that's a metals market, a precious metals market that's traditionally a flight to quality. Crude oil, can be more of a risk-on trade when times are good, economic growth, more crude oil demand for industrial uses or consumer uses. And you can see here that crude oil has a high correlation with not only energy stocks, but the Dow Jones, with materials stocks as well, whereas gold has had a negative correlation to some of the stock markets there. But also you'll see Canadian dollar, a high correlation to crude oil as well. Canadian dollar is a commodity currency there. Canada has a lot of exposure to crude oil. And so when crude oil is doing well, you'll see the Canadian dollar do well as well there. And also a bit of a negative correlation to US dollar there. But anything that's within, positive or negative 0.2 or 0.3, not really that substantial. So if you're trading crude oil relative to another market, you would want to be looking at those energy stocks, those material stocks, or the Canadian dollar. And now let's finish up with this example of gold prices and yen to see what you might look at in terms of a trade, because it's nice to see the relationships and know what's going on in your overall economy. But you could look at a pairs trading strategy for potential risk reduction instead of maybe just selling gold, for instance, and having a bunch of risk to the day-to-day gold price fluctuations. You could sell gold and buy something that you think is undervalued and highly correlated to gold, in this case, looking at yen. And now the trade becomes a convergence versus divergence trade. And you can see that both these markets positively correlated. And especially in the last few months, they look like they're headed in the same direction. They both bounce off of their lows at the end of 2022, rise at the start of 2023, take a little bit of a dip about a month or two ago, and then rise again here. But the difference is on this secondary rise, gold has ascended all the way back up to 2000. Yen made a little bit of a bounce, but has given away a bunch of ground. So what you could do if you want to bet on convergence, for example, you could sell gold, buy yen. If you think that they're going to continue to diverge and that gold is the big flight to quality, yen is no longer a flight to quality, you could buy gold, sell yen, and look at a divergence trade. And there's a little pairs trading example coming off of some commodity correlations.